Hello, folks. This is Raj Sastri from Raj Option Trading. Today is May 23rd, 2021. We will talk about stock and option trading ideas for the week of May 24th, and we'll look at TTM Squeeze, which is a indicator from John Carter. So we'll see what are the good buys from a stock perspective, or even a call or a call spread. So with that, I got a image here talks about TTM trade here. This is for a stock called BJ's Wholesale. I think it, as you can see here, it's a nice setup here. We will take a look at a couple more symbols and see what makes sense and dive in. So with that, here is a quick list here. The way to read this chart is I got all the ticker symbols on the left here, right from Virgin Atlantic, Virgin Galactic, all the way to Darling Ingredients. And I got price, market cap, sales, and sales growth itself from a 1 year basis and quarter to quarter. I have gross margin and institutional ownership, and if it is any short ratio that's shown here. We got price to sales ratio, talks about is it more expensive from a valuation perspective or not so expensive. We got IV percentile here. IV percentile is very important. When the IV percentile is relatively low, that's when you want to sell or you want to buy options. Example, call options or call spreads. When the IV percentile is high, that's when you want to basically sell some of these premiums like put options, or even sell some call spreads above the stock price. And we also look at RSI. RSI is very important. If you're a buyer of call or call options, you want the RSI to be relatively low so stock can go higher. And we have to pay very close attention to volume. We got to make sure the stock or the option we are trading is very liquid. That's why I've listed these stocks where volume is greater than 1.5 million shares. And also we have to look at the squeeze indicators. There is a 3 days, 1 day squeeze, 3 day squeeze, 1 week squeeze, 1 month squeeze. So 1 day squeeze will last for a couple days. One 3 day squeeze lasts for a couple say in 3 day multiples, maybe a couple of weeks. And 1 week squeeze lasts for weeks, and 1 month squeeze typically lasts for months. So typically when you get multiple squeeze at the same time, that shows you it's a little bit stronger from a squeeze perspective. And we also have to take a look at the earnings. If the earnings is around the corner, you got to be a little careful when you're buying or selling options, and even stock for that matter. And I have also listed 1 month performance, 3 month, 1 year performance, and also how far it is from the 52-week high. So normally if you want to buy a stock, you got to make sure you have a good entry point where it's not really trading at 52-week high. You got to make sure at least it's pulled back a little bit, so that way it will give you some room for growing. We call it margin of safety. There is some, if you look at the technical indicators, you get a good entry point when you want to buy the stock or even the option. So with that, this is where I've looked at 1 day squeeze, 3 day squeeze, 1 week squeeze, and 1 month squeeze, and looked at what stocks we can buy or even options we can buy. So with that, first couple of them, Virgin Galactic and IPOE. These two, as you can see, there is no sales, and I think Virgin Galactic had some a successful launch when it comes to tourism to the space. That's why stock is kind of going up crazily, but they're still down 66% from 52-week high. And IPOE, it's again Chamath, his SPAC here. I think it's showing some progress. As you can see here, it's got a 1 week squeeze here, and they're down 33%. So we can take a quick look at Virgin Galactic and IPOE and see if it makes sense, because sometimes you got to be careful when a company does not have any sales. You got to kind of, it's really speculation, pure speculation, because there is no sales at this point. So with that, let's go into Thinkorswim platform and look at SPCE and see it's a good one to either buy the stock outright or even buy call options or call spread. So I'll go here to Thinkorswim platform. Let's put SPCE. So as you can see here from the, let's go to a little bigger chart here. So if you look at SPCE, let me go back here. As you can see, a stock has done nicely. Last Friday, they're up $1.26, which is 6.36% up. That's a big move for this stock. And if you look at the on the balance volume, it shot up, as you can see here. And the RSI also shot up on the good news. And the DMI is showing, it's some progress. The blue line is trying to go up, red line is trying to come down. That's a good indication. And volatility itself has cropped up a little bit, as you can see here. And check-in money flow is indicating, more smart money is kind of flowing into the stock. It's a little bit flat right now. That's okay sign. So with that, implied volatility right now is 51.8. Normally, if you are a option buyer, you would not buy the option when the implied vol is high. But if you are a put option seller or a premium seller, it may be okay for you to sell some premium at this point, especially because, as you can see here, the volatility itself is going up at this point. And coast is clear. There is no earnings. Earnings already happened back in I think 5:10 last week or a couple of weeks ago. So with that, if you go into TTM Squeeze chart here from from John Carter, it's a Thinkorswim chart. It's basically indicating there is a daily squeeze about to form. We don't see the squeeze yet, but it's about to form. In the meantime, if you look at TTM wave, this is a C wave or A wave, which is shorter term wave. The line, the blue line, which is a bullish sign, it's above 0. That's a bullish indication. And if you look at the A wave, we see the line, the light blue line. Light blue indicates a little bit bullish signal, and dark blue indicates bearish signal. But the light blue line is below 0. That means it's not quite all right to buy at this point. We would like to see the setup where these light blue lines are above 0, but in this scenario light blue lines are below 0. That's not a great signal to buy. So that's why I don't feel very comfortable, initiating a buy option, a call spread here. But if it's a stock purchase, if you want to buy the stock itself, it may be okay to buy the stock. I do see, that may be okay to do at this point. It's $21. It's okay to buy stock for the long term. So with that, let's also look at one more chart here. So the way TTM squeeze indicator works is really, as I have plotted here, a Bollinger Band. Bollinger Band is really where you see the the dark lines here, which is the upper band on the top here, red one, and there is a pink one here, which is the lower. So that's the Bollinger Band. I also have the dashed line here, the yellow on the top and red on the bottom. These are the Keltner tunnels. As you can see here right now, Bollinger Band is trying to be, trying to a little bit go near the Keltner tunnel. And that's why, as Bollinger Band gets inside the Keltner tunnel, that's when we call it a squeeze has formed. So that indicates a moment of lower volatility, and that will result in stock going up or down pretty quickly. So in this scenario, because it's not quite there yet, it may be about to be forming, but looks like stock has moved up and down a little bit. So it may not be a good idea to trade option at this point, even though if you're a long-term option buyer, it may be okay. But if you want to buy stocks, that's good. So for this one here, I think good strategy could be to sell a put option. For that, let's go in here to a Thinkorswim trade tab here. So here, if you go to trade tab for Virgin Galactic, If you want to sell put option, you normally go about 40 days out. So you could do something like this. And if you look at stock itself, $21 stock, it's gone as high as 62. And there is some positive catalyst, as you know. They have already had a successful flight to the space. So what we can do is really $21 stock. You could go somewhere around delta 22 or so, $17. You could sell a put option right here. You'll collect $1.13, and that's $113. If the stock comes below 15.87, then that's your break-even point. You'll start making losing money. But if the stock stays above this price, you'll make money. So we are doing this because implied wall is a little bit higher, 51 or so. If the implied wall is below 50, we would initiate a call option and buy some call here. So with that, it's one strategy. This really to sell a put option for Virgin Galactic because IV rank is a little bit higher. Next, let's look at IPOE. It's again a SPAC, and they have a relatively okay type volume, 2.9 mil. And as you can see here, they have not done much. In 1 month they've gone up, but 3 months they've gone down. So let's see if it's worth our attention here. So for that, let me quickly go back to Thinkorswim. I'll put IPOE. So as you see here, I'll go to one of the chart here. All right, so if you look at IPOE, it's trying to go up, as you can see here. It's above the typical moving averages. That's a bullish sign. Volume is kind of going up. That's also good. On the balance, volume is going up. RSI is also trying to go up. Good sign. DMI coast clear. The blue line is above red line. And implied wall, as you can see here, implied wall, which is this blue line here, is higher. It's 85.9. And also smart money is flowing into the stock. So because implied wall is high and stock is bullish, I would not be buying call option at this point, because if you buy call option now when implied wall is high, you will end up paying too much money for this. And if you also look at TTM squeeze indicator here, let's see here. From a TTM squeeze perspective for IPOE, as you can see here, it's squeeze has not yet formed in the daily chart, but the line is above zero. The C wave is above zero. That's bullish. A wave is above zero. That's also bullish. And I think looks like here also we have wave a C wave above zero. That's bullish. So with that, the bullish indication is there. Only thing I'm a little bit concerned about is the volatility, which is high. So with the volatility is high, I would rather do similar strategy, which is selling the put option at this point. Maybe say in this case maybe 54 days out. Stock is 18.78 at this point. You could look at delta 24. This is fine, $18. Or if you want to be a little bit conservative, you could even do 12.5. If you do 12.5, you'll get in around $81. It's 54 days out, so I think it's you don't want to be selling put options too far out. This is a good strategy. So you could just confirm and send. If the stock stays about $11, you'll break even and you'll bring in $81. And if you want to be a little more aggressive, you could even do $15. You could you'll bring in $178. You could do something like this. So that's another way to do. If you don't want to be taking too much risk, you could even sell put spread. You could do 15-10 spread here. So if you do that, you could sell here. You are selling 15, buying back 10. So you're bringing in $1.56. For some reason, if this pack blows up, you will lose maximum in this case $500. So this is the other way to play this, because you brought in $156. Your max loss is 344. This is a little bit a conservative strategy if you don't want to spend too much time worrying about how much will I lose. It's a conservative strategy. You'll still bring in good amount of money. So with that, let's go back to here. We got a couple more going on here. We got Enphase, BILI, Vistra. I also listed, highlighted some of these stocks here, like AWK, EA, BPY. So if you look at some of these things, AWK as an example, and if you go back to Thinkorswim, American Waterworks. So, this is a, setup wise, it's a little bit better setup. As you can see here, we got a daily chart, not quite formed yet. And the line here, the C wave is above zero, and it's the light blue, which is a bullish sign. And here the yellow is bullish, the bar is getting shorter. If it goes above zero line here, that's bullish. Right now it's not quite there yet. And if you look at a bigger chart here, um, here as you can see here, we got Bollinger Band is trying to go inside the Keltner tunnel. That's when the squeeze is going to be formed. On the balance volume is going positive. That's a good sign. And if you look at one more chart here, all right. So if you see here, volume is good. On the balance volume is positive. RSI is trying to go up. And if you see a DMI, the blue line is above red line. Coast is clear. It's bullish at this time. And the implied vol is 22. So that's relatively low. So for this one, if you want to, buy a call option or a call spread, you could do it. You're not paying too much money. Given the IV percentile is 22.7, and the RSI is also relatively low, 54, which is okay. So with that, if you go back here to American Waterworks, to option chain here, when we are buying call option, we want to go a little bit far out. Once 117 days out is a good time frame. So we could do 155 right now. We could do delta 70. If you do this, you'll pay $14.40 here. You could buy the call option outright here. You'll pay $14.40, which is 1,440. Your max profit is infinite. Your break even is 159. Stock has to go to 159 for you to make profit. So this is one way to play. But if you're a little bit risk aversive, you should do maybe a call spread. So for that, you could do something like, right now it says 155. You could do 150, 160 spread. There you go. It's a $10 spread. You're paying $5.50. Remaining $4.85 is your profit potential. So if you confirm and send here, you're paying $5.15. You're making $4.85. You're almost doubling your money. This is a little more conservative way to play. So if you could also do a little differently if you want. Right now it's at 155. If you are a little more bullish, you could even do a little bit different. You could do 150 and 165, $15 spread. You could do that too. So if you do that, you're paying 515, and it's a 15 in this case 165. There you go. It's a $15 spread. You're paying $6.90. In this case, you're making a little more. You're paying $6.90. You're making $810. You're making more, doubling more than your money, which is a good strategy. This is if you want to if you can put a little more money into this trade, you could do something along these lines. So let's look at one more here. We got a couple more here. We got Electronic Arts, which is also a good one. And let's also do one thing. Let's look at some of the weekly squeezes. For that, let's look at BJ's Wholesale, ticker symbol BJ. If you go to BJ here, I think BJ's had a quarterly earnings. After the quarterly earnings, stock has sold off a little bit. So if you look at BJ's here, as you can see, your stock has fallen off a little bit. They're down 1.06% last week, and implied wall is 5.7, very, very, very low. And as you can see here, IV itself is low. RSI is 50, which is mid-range. On the balance, volume is coming down now, understandable after stock goes down. Check-in money flow is down now, trying to stabilize a little bit. So BJ's, I think if you're a stock buyer, you could buy the stock outright and keep it for a long time. If you're an option buyer, you could do, because implied vol is low, you could buy the option outright. So with that, let's go to a different chart here. So if you look at TTM trade chart here, as you can see here in the 2-day chart, we got a dot here indicating there is a squeeze, and the line light blue line is on the top. That's bullish. In the shorter term A wave, the yellow line is above zero. That's again bullish. And in the C wave, longer term C wave, the lighter blue lines are on the top, which is again bullish. So typically the way to read these charts is, in the TTM squeeze itself, the light blue is bullish. You want the light blue to be above zero, and the dark blue is a little bit bearish, and the red is also a little bit bearish. And in the TTM A wave, which is shorter term wave, the yellow is bullish, the red is bearish. If you want the lines to be above zero, that's again good sign. And in the TTM C wave, the light blue lines are bullish, dark blue lines are bearish. You want the lines to be above zero, which is bullish. If the lines are below zero, that's not a good setup. So with that, for the BJs, as you can see here, we got a squeeze here in the 3-day chart, as you can see. And the setup is good because C wave, longer term C wave is above zero, shorter term A wave is above zero, and TTM squeeze itself, the lines are above zero. And there is also a squeeze in the weekly chart. As you can see, this is a weekly chart, and the lines are above zero, light blue, which is bullish. In the shorter term A wave, lines are above zero. It's again yellow lines, which is bullish. And in the TTM wave, C wave, longer term C wave, the light blue bars are above zero, which is again bullish. So with that, this is all clear type signal here for this to squeeze on the higher side. So we can also look at a bigger chart here. So for that, we'll go to this chart here. So as you can see here, we got on the balance volume is a little bit dipping, which is understandable. Stock came down. RSI is stabilizing at 50, which is good. Right now, if you look at the DMI is showing the red line is above, green and blue line, which is a little bit bearish. But as you can see, a red line is trying to go down a little bit as we speak. Check-in money flow, smart money is flowing into the stock, which is good. And the actual volatility itself is dropping. That's when you buy either stock or call option. So with that, we feel very good. This is a very great setup actually. You could buy option here. So let's go to the actual option chain here, and we'll typically, because we're bullish here, we could go 180 days out, and $45 stock here. You could do something like delta 70. You could buy this here, delta 73. You pay $8.60, and you could go just confirm. So you're paying $860 for this trade. Your profit potential is infinite. You want the stock to be above 48.60 by 19 November for you to break even. So this is a good setup. You're not paying too much money. So if you don't want to pay so much money, you could even do a spread here. It's a $45 stock. You could do a 40-50 spread here. So for that, you could go here, buy a vertical spread, 40 and 50. There you go. So you're paying $5 and 5 cents, and you're kind of almost doubling your money. So this can be a conservative strategy here. If the stock is above $45.05, which is below the current price, you will make money. This is a little more conservative strategy. It kind of, because you're selling a higher price call option, buying a lower price call option. The impact of volatility will be low for you. Impact of theta decay is lower for you. This is a little more conservative. Sometimes when you buy the call option outright, you are kind of faced with the theta decay. If the stock comes down drastically, you lose entire money. Whereas here, because you are buying and selling, your theta decay is kind of compensate a little bit. It's a little more conservative strategy. Only caveat is you will not make as much money or infinite profit potential like you have in the selling the buying the call option outright. So that's the only drawback here. But I think you can sleep at night peacefully if you buy a spread, because you can only lose so much money, and it's a different way to play. So with that, let's go back. Let's look at maybe one more trade here. We got Best Buy, BHP, and Darling. So as you see here, I think um, if you look at Darling here, Darling, $68 stock. They've got good sales and sales growth from a 1 year quarter-over-quarter perspective. Stock is done very nicely for 1 year, and they're down 14% from 52-week high. So you could go back here and basically look at Darling. There you go. It went up $2 on last Friday, and if you go to the chart here, from a TTM chart perspective, there is a squeeze indication forming here in a 3-day chart. As you can see here, there is one more squeeze forming in a weekly chart. And if you look at the chart here, there's a squeeze, there's a red line forming down here. So it's not a clean setup, because I would love if there is no red line down below zero line, but right now we have some red line. But as John Carter says, you can ignore the shorter term lines here, and you could focus on the longer term. In the longer term lines, as you can see here, we have some dark blue lines forming here. I would have loved to see the light blue lines forming here, not dark blue. And also, if the light blue lines are taller than these lines, then it would be a good setup. So in this case, it's not a great setup. So I would I would probably not take this trade, because we don't want to lose money on the trade. So we can also look at one more chart here. So let's look at this chart to see what's going on. So on the balance, volume is positive, that's good. RSI is trying to go up, which is good. And DMI chart is telling us right now it's bearish, but blue line is trying to go up, which is good. And implied vol is low, so it's about 34 percentile. So it's okay to buy call option when the implied vol is around 34, no big deal. Check-in money flow is showing a little bit negative trend. So what by looking at this, really I feel like hey, this may not be a great setup to buy a call option at this time, because it's not a great indication, coast clear type indication. But you could also do different strategies here with the implied vol is low. But buying a call may not be a great idea at this point. And even buying a selling a put option is also not a great idea, because implied vol is low. And you could do certain things here. You could even what normally you can do is, really if you want to take this trade, you could go to trade tab here, and good idea is really go maybe say for 54 days out or even 145 days out. You could basically do a straddle. So because implied vol is low and there's a squeeze about to be forming, $68 stock, you could do close $70. You could sell you could buy a straddle here. So there you go. To buy the straddle, you're paying $15 at this point. Your thought process is at this point implied wall is low, and implied wall is going to go higher. As implied wall goes higher, the straddle that you bought for $15 will go higher. That's the thought process here. You could confirm and send. So if you don't want to pay so much money for the straddle, you could do a little differently. You could even buy a strangle. So to buy the strangle, you could same strategy. It's around $70 here. You could buy and do a strangle. So because you're buying a strangle, you're buying a call here at 70 here above the stock price, and you're selling a put. You're buying a put. You're buying a call and buying a put. You're buying a put at a lower price. So you're paying a little bit less money here, as you can see here. This is the other way. Volatility. When the volatility is low, you want to be the buyer, and in this case, you're buying a strangle and hoping volatility will increase and you will make money. So this is other strategy to do. If you don't want to even do this because you're a little bit afraid you're paying so much money, you could even buy a iron condor as an example. That's the other way to do. When the volatility is low, you could even buy your iron condor. So for that, you could do 70 here. You could go here and buy iron condor. There you go. So you are basically doing 70s, 75, 70 call spread, which is above the current price, and you're selling a put spread. You're actually buying a put spread here. You're buying a call spread and buying a put spread here, 60, 65. So you're paying $4.05 here for this spread. And if you confirm and send here, your max profit is 95, your max loss is 405. So this is not a great strategy because you're not making too much money. I would not go with this strategy because it's not giving us too much benefit. So with that, let's go back and maybe look at one more here. ONEOK is a good stock, because energy is going up these days. ONEOK, only problem is ONEOK is it's hardly 3% away from the current 52-week high. So I would not go with ONEOK. Other one is really here, American Express, same story. It's almost at a 52-week high. Probably not a great idea. eBay could be a good one. Let's say it's 6% off of 52-week high. We can take a look at either this one or even EA. Electronic Arts is a good one. Let's look at Electronic Art very quickly. Electronic Art, as you can see here, TTM Squeeze chart here. There's a squeeze forming in a daily chart. And as you can see here, the line in the C wave, longer term C wave is above zero. It's light blue, which is a good sign. And shorter term C wave or A wave, there's a yellow bar which is getting shorter. Right now it is a little bit negative, but we can discount the A wave because the C wave is above zero and it's light blue. And as you scan through here, we got a squeeze forming in a weekly chart, and we have longer term A wave above zero, longer term C wave above zero, and short term A wave trying to get above zero here as we speak. So that's a good setup here, with EA, and we could look at a different chart here for EA. So if you look at EA here, on the balance volume is good, pretty steady. RSI is 50 midpoint. Here, this is a little bit better setup here. DMI showing the blue line is above red line, which is bullish. Implied wall is lower to flat, which is good. And check-in money flow is indicating money is not flowing into the stock right now. It's flowing out, which is understandable with the negative candle here. So with that in mind, I feel good about buying the call option here, and at least maybe a call spread here, and go from there. So typically the way you need to look at is really if the stock is all clear, meaning it's in a good positive trending up, then it may be okay to buy a call option. But if it is a little bit showing like this, it's not a very nice setup here. You could do call spread and be conservative. So with that, let's go back. From a TTM perspective, if you go back here, it's a good setup. As you can see here, it's above zero, weekly chart above zero. So with that, let's go in and basically buy a call spread. It's a $140 stock here, and if I go here, I should because I'm buying a call option or a call spread, I should go at least more than 3 months out. 117 days is good, so I should go 140 right here. So I should do probably 135, 145 call spread. So I could do here buy vertical 135, 145. There you go. So if you do that, you are paying $4.75. Is a $10 wide spread. Your profit potentially the difference, which is $5.25. You are more than doubling your money with this trade. Your break even is 139, which is just below current stock price. It's a little bit conservative strategy. You could do something like this. So with that, this is the whole list. You can just look at some of these symbols, just the way I explained. With that, thank you very much. Happy investing and trading.